Hey, what's up, everybody? It's Tuesday, March 9th. So the NASDAQ had a great day. Up sharply, as I said would happen. Dow up, S&P up. Now, I've been talking about this situation with reserves in the banking system and the leverage ratio and how that could cause problems for the banks. And we're getting towards the end of, as we come towards the end of March, remember that exclusion that was put in place last May by the Fed, where banks were allowed to exclude reserves in the calculation of the leverage ratio. Well, that thing now, and I've been talking about this for 2 years, folks. If you've been following me, and you could go back to 2019, I started making videos on this with the supplemental leverage ratio and how that causes banks to have to make adjustments when all these reserves come piling onto their balance sheet through, government spending or the Fed's QE, quantitative easing. That's another thing that's going on right now. Anyway, Goldman Sachs supposedly stumbled onto this problem. I've been talking about this for 2 years. So there was a big write-up about this on that blog, Zero Hedge, and they talked about how, it could end up being what they call a $2 trillion problem. And the banks, unless there is some regulatory relief by the end of March, in other words, unless the Fed extends that extension, or if they do away with reserves in the leverage ratio calculation altogether, which I doubt very much they're going to do, the banks are going to have to make some adjustments, and that could have negative implications for the markets. It could certainly have negative implications for bank stocks. Let me put it this way. I have two trains of thought on this right now. Number one, everybody knows about this situation right now. When I started talking about this in 2019, I was the only voice out there talking about it. Now, when it shows up on a blog like Zero Hedge, you better believe that everybody knows about that, number one. Number two, I am sure that Jamie Dimon and the heads of these major banks are calling up the Fed saying, hey, we're going to have problems unless you do something about this. What's astonishing, and this is kind of a sidebar, is that the Fed continues to buy assets at the pace of $120 billion a month, adding $120 billion a month in reserves onto the problem that already exists. There's no reason for the Fed to be doing that. They just keep doing that. So they're part of the problem too. But I'm sure Jamie Dimon and other bank heads are, letting the Fed know, alerting the Fed that, hey, we're going to have this big problem at the end of the month unless you do something. Now, will they do something? Right now, there's opposition to any relief, and that's coming from the FDI chairperson who says banks don't need any more relief. It's coming from Senator Elizabeth Warren, who else? And it's coming from Senator Sherrod Brown. They wrote letters to the Fed saying they do not want to have this thing extended. So that leaves the banks with, fewer options, let's say. They can sell equity, they can sell stock, and I'm hearing the mode that they would choose would be preferred stock. Now this would not lead to a dilution in stock prices, but it would lead to a hit to earnings. All right, that's one thing. They could curtail or end share buybacks. All right. They could also, from what I'm hearing, turn away deposits, which to me seems hard to imagine. Can you imagine somebody coming in with a Social Security check and they're saying, no, we can't deposit your check? I don't think they're going to go that route. I'm not even sure how that works. So it seems to me like unless there is some regulatory relief by the end of the month, and I still think maybe that's going to happen even though there's opposition to it right now. I mean, they're going to have to understand that, it could really screw things up for the banks. Another thing is it could harm loan growth because, the banks are going to have to slow down the accumulation or creation of other assets if they're getting this tsunami of reserves pouring onto their balance sheets. And you don't want that, right? I mean, the flow of credit to the economy, especially now when the economy is starting to open back up, I mean, that's primary. So, I mean, it looks like could be in for a rough patch for the banks for a little while. Actually, I would welcome that. I would hope, I was, if you were listening to my videos last year, I was saying you got to buy bank stocks. You got to buy bank stocks. It was so much cheaper. I mean, that was like the value sector of the stock market. And what happened? We had this really big run up in bank stocks, and now I'm more cautious on it because, of what's about to happen. Also, we've seen some of the numbers like in bank residual, which is literally their net worth. It's asset minus liabilities. I mean, down at a 29-month low. So a little bit cautious in the banking sector. But yeah, I mean, Goldman just, stumbled on this. Now, I mean, Goldman Sachs, come on, where you been all this time? I mean, we've known about this situation, and it just seems to me kind of strange that they're just figuring this out now. But if Goldman knows about it, I'm sure Jamie Dimon knows about it. I'm sure the Fed and everybody else knows about it. And usually when something gets to be kind of broadly understood, there's going to be some reaction to it. It takes time to build up to a degree to get people to do things. But it's interesting. I just wanted to point that out, that, it was something that I said 2 years ago. This was a tradable. In fact, I used to say that these were tradable events. These were tradable developments. I mean, we used to follow this stuff, on a month-to-month basis, and it was very predictable. When they suspended the treatment of reserves last year, it kind of smoothed everything out. So you didn't have these monthly or bi-monthly fluctuations. But it may come back, and these are tradable patterns. They're based on these flows, these reserve flows, and the need of the banks to have to do something as a consequence. So we'll be watching it. What's today? March 9th. Still 3 weeks left to go, but pretty interesting. Goldman making that comment today. Anyway, I made a new podcast today. It'll be up on my podcast site tomorrow. I'll let you know. In the meantime, don't forget, check out my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. See you tomorrow. Bye-bye.